Hey everybody, so a couple of weeks ago, one of my subscribers actually sent me a video by a YouTuber called Cryptoslo. The video that was sent to me was titled The Tax-Free Crypto Withdrawal Strategy. So basically in this video I want to talk you through this strategy and give you some of my own thoughts on what are some of the risks associated with this strategy and in what situations it might be actually useful to use it. So let's get straight into it. The topic that the Cryptoslo channel was covering was in relation to the tax implications of taking out loans with your cryptocurrency. I'm also going to leave a link below in the description section to his video if you want to check that out as well. So one of the biggest growing spaces in crypto in the last year has been the DeFi space. With DeFi, you can either lend out your cryptocurrency to other investors and receive interest for doing that, or else you can also yourself borrow on the back of the cryptocurrency that you own. As of the time I am recording this video, there is about $77 billion locked up in DeFi protocols such as Compound and Aave. So it has become quite a sizable market. I will explain exactly how these DeFi loans work in a moment, but firstly I want you to imagine a situation that maybe a lot of you have already experienced. Let's say you got in nice and early on something like Bitcoin, Ethereum or Cardano and you are making nice profits. You have say 50,000 in profits sitting there now at the moment that you haven't actually cashed out. You are delighted with the profits that you have made and you would like to access some of the value that has been created. But you still want to hold onto your crypto because you believe there is a lot more growth to come with the current bull market. You know if you sell any of it or convert it to a stable coin, you are going to create a taxable event. And as soon as you create this taxable event, you're going to completely destroy a lot of the value. I know myself, I live in Ireland and the tax rate is 33% on capital gains. So if I sold anything, I would completely wipe out 33% straight away. So that is going to damage any long-term potential of further growth with your crypto. So ideally, the best strategy is to hold it until you have reached the target that you are happy with to take your profits and run. So what options have you to access some of that value as it's growing, but not create a taxable event? You can take out a loan with your crypto without causing any of these taxable events. I'm just going to take you through a practical example of how one of these loans would work if you had borrowed on the Compound Finance protocol. And along the way I will point out some of the risks from my perspective. And just to be clear, this video was not made as tax advice whatsoever. When it comes to the taxes around your cryptocurrencies, make sure and get some professional advice. So here is the Compound Finance lending platform. As you scroll a bit down here, you'll be able to see all of the different cryptocurrencies that you can either lend or borrow. So if you're planning on using this strategy for Ether, this is one of the places that you could come because they allow you to use Ether as collateral for your loans. As with any type of loan, there's obviously going to be some sort of interest. So you can see the interest rates here also on the right hand side associated with each different cryptocurrency. Before I just go through a practical example here with you, I just want to explain what the collateral factor is. So this is very important for you to understand how these actually work. So the total amount you will be allowed to borrow depends on the collateral factor. And this collateral factor will vary from asset to asset. The collateral factor for Ether is 0.75. So what this means is if you put up a collateral amount of 100, this will give you a maximum borrowing amount of 0.75 times that $100, which means you can borrow up to $75. I have another video on my channel that goes through Compound Finance in a bit more detail if you want to check that out, and that will go through all of this kind of stuff a bit better. Right, so now let's have a look at the practical example. So let's say a few years ago you bought some ETH, you bought 10 ETH, and obviously this has increased significantly in value since, and let's say at today's value, let's say it's worth $3,000 per ETH. So that means you have a total value of $30,000. So if you wanted to access some of this, you could deposit your 10 ETH onto the Compound Finance platform. And this would allow you to borrow up to $22,500. So that is the total value that you have supplied in collateral, which is the 30,000 multiplied by the collateral factor of 0.75. Which is a max borrowing power of 22,500. So with this borrowing power, then you could go off and borrow, say, $10,000 worth of DAI, which is a stable coin. You could then send that stable coin to an exchange like Coinbase or Binance and then cash it out and use the funds. Obviously, though, this is a loan and you will have to pay it back eventually. But this is just a way that you can get access to some of the funds that you have currently locked up that you don't want to sell. But what are the risks associated with doing this? Let's say, for example, you actually borrowed $18,000 worth of stablecoin and cashed it out. and that meant you only had margin of safety of 4,500. That is the difference between your max borrowings here of 22,500 and the amount you did borrow. So if this debt to borrowing ratio actually falls to 100%, your collateral can get liquidated. And so you don't want that to happen. So this strategy definitely is not a good idea to be doing in a very volatile time. So let's say, for example, as we have seen recently, that the price for ETH actually went from 4,000 to 3,000 there recently. But let's say it even dropped further and dropped down to 2,000. So in that scenario, your max borrowing power has dropped to 15,000, but you've actually borrowed 18,000. So when you owe more than you're allowed to borrow, you are putting the whole pool at risk, and this makes it difficult for the protocol to make good on its interest rate payments. So when your debt to borrowing ratio falls to this 100% level, it's actually liquidated. And it's liquidated at a discount. So your ETH that you have put into the lending platform as collateral will be sold off at a discount at about 8 to 10%. So that is quite a sizable chunk that you're also going to be losing during the liquidation process. So this liquidation process is the only way they can keep the whole system going. So obviously you only want to use this strategy if you're in a bull market and you're confident that the price is going to keep continuing to rise. So let's say the ETH price continues to rise. It was 3,000 when I first took out the loan, and let's say it's gone up to 4,000. So as the ETH price rises, it gets less and less likely that I will have to face one of those liquidation events. So that is the strategy in a nutshell to get access to some cash without causing any taxable events. I'd love to know what some of your own thoughts on it are. Leave me know in the comments. I don't know if I would recommend it to anybody else. It seems a bit risky, and I don't think I would ever implement the strategy myself if I'm being honest. But please, as I said, leave me know what you think in the comments. So that's pretty much it for my video today. Thanks very much for watching. If anybody is new to crypto and wants to start investing, you can use my Binance link below to get some discounts on your commissions. I'll talk to you guys again soon.